Hey guys, listen and listen closely. Back the money truck up. It's now the best time in history to invest in multifamily real estate, where you can buy the best multifamily real estate at steep discounts. But wait, hold on a second. Are you really sure about this, Dr. Jonny Walker? Is it really the best time to invest in multifamily real estate? I mean, how could this be true? Multifamily real estate and commercial real estate values in general have declined 25 to 30% over the last couple of years. We've seen rents that we were told that are going to continue to increase because of the supply-demand imbalance. Instead, we've seen rents stabilize and in some places even start to go down. On top of that, many of the people that have invested in multifamily real estate and in other types of syndications, they've witnessed pauses in distribution. Hey, we're not giving out any more cash. And in scarier circumstances, people have been asked for capital calls, right? Where the sponsor comes and asks for more money beyond your invested capital. And in very, very unfortunate circumstances, we've even seen defaults on mortgages and foreclosures where investors' capital has been wiped out completely. So is it really the best time to be investing, doctor? Well, that's what I'm going to try to convince you in this video. And I'm going to tell you what the data shows. And if we follow the data, we can predict what future is going to look like, and we can alter our investing thesis based on that. And hopefully by the end of this video, you're going to see why I say back the truck up, because there's a ton of wealth to be made. All right, welcome back to the channel. I'm Dr. Jonny Walker, aka Dr. Jonny Withananchi. I'm a veteran endodontist as well as a self-made multimillionaire in real estate investing. I am the principal and founder of Walk of Wealth Capital, which is an investment firm that helps dentists to invest in real estate and alternate assets so that they too can achieve financial freedom through passive investment. Up to this point, we have invested in over $352 million of commercial real estate, and I've helped multiple dozens of dentists achieve multiple streams of passive income. All right, let's get into today's video topic. Have you ever heard of a thing called a CLO, or a Collateralized Loan Obligation? This is a fancy Wall Street term, right? A financial term used for the lumping together of hundreds, sometimes even thousands of mortgages into one package. And what banks do, right? Primary banks that do the lending, they lend money to, investors, to multifamily real estate operators, etc. And eventually they get to the point that, hey, they've lent out all the money and now they have no more proceeds to lend out. So what they do is that they sell these loan products on a secondary market through these CLOs, or Collateralized Loan Obligations. And they're purchased from other institutions that now reliquidate the lender so that they can start lending again. Now, the great thing about these CLOs is that they're under the analysis of some of the most astute analysts in Wall Street. And the CLOs give us a tremendous amount of generalized data across an asset class and an industry. And the data shows that in these CLOs, in the upcoming 0 to 24 months, we are going to see things really start to unravel for multifamily real estate operators, especially the ones that have floating rate mortgages or bridge debt financing. Many of these operators are staring down the barrel at extremely large rate hikes from the very low rates that they had in place when they initially bought the properties in the 2020 to 2022 range, in that range. Now, if you bought properties at the peak of values, at the lowest interest rates, lowest cap rates in those years, and you got a 3-year fixed rate, and then it floats to whatever the prevailing mortgage rate is, then all of a sudden you might have bought a property at 3% in 2020, 3 years later in 2023, or maybe you bought it in 2021 or late 2022. And it's now 2 years later, it's 2024, and you know that, hey, 6 months from now, my term is going to be ending and my interest rate or my mortgage payment is going to go up 250%. I know I won't be able to afford it. And so I need to get rid of this problem. I need to get rid of this property before this loan matures. Otherwise, we're going under, like the Titanic. Now, rising interest rates and rising rising mortgage payments that come with it are only one of the problems or distresses that these multifamily real estate operators are facing. The other ones are, hey, there was such a run-up in property value in 2020, 2021, and early 2022, the multifamily real estate property values skyrocketed. And as a result, since the property values are higher, the state and the county say, hey, you know what? Property taxes have to also go up because the values have gone up. So we've seen property taxes jump. Insurance jump as well, right? The insurance premiums have gone way up too. These insurance brokers have to incur more risk because the property is worth more. It's going to cost them more money that they have to outlay. They have to increase the premiums. On top of that, the problem is further exacerbated in flood areas and coastal cities that have the potential for hurricanes. And property insurances have skyrocketed. So when you combine these factors, rising interest rate, rising mortgage payments, rising property taxes, rising insurance premiums, all of a sudden we're faced with the most challenging time to be a multifamily real estate operator, maybe ever in this country, right? These are extremely challenging circumstances for operators to try to trepidatiously get through it. And the fact is, many of them won't. We have seen a surge in the number of multifamily real estate operators doing capital calls. They know they're going to need more capital. They do not have enough money within their business plan and within the purviews of their business plan. They didn't see these interest rate hikes coming, the fastest interest rate hikes in the country's history, right? Who could have seen this coming? On top of that, we've seen an uptick in defaults and foreclosures, right? These interest rates have gone up. These guys can't make the payments. And if they can't get rid of the problem, they can't solve the problem somehow, worst case scenario happens, the bank takes it back. Like, hey, look, you can't make the payments, give us the property. So the bottom line is that there is major uncertainty in the multifamily real estate sector. Capital calls, foreclosures, paused distributions, upset investors. Investors have been wiped out. And I thought multifamily real estate investing is supposed to give us stability of cash flow. It's supposed to decrease the it's supposed to give us downside protection. What is going on here? Well, we are facing circumstances and situations that we haven't seen before, to be quite honest. And all this uncertainty creates worry, and it causes people to take a giant step back from investing. Hey, look, I'm not investing anymore. I want to see what happens. The Feds are saying that inflation hasn't slowed down. Interest rates might even go up again. Forget the rate cuts that are supposed to be coming. What is going to happen in the future? I don't know. I'm just going to wait and see. I'm going to step out of the game. And that has happened for investors. That's happened for buyers. That's happened for lenders that are, banks. They don't want to get caught in a situation where interest rates might be going up. They are going down. They don't know. And uncertainty creates pauses and stop. And as a result, we've seen sale and transactional volume of commercial real estate fall off a cliff. 2023, 2024, we've had very few transactions compared to the preceding couple of years. Here's the key takeaway. This is what I want you to get from this video. Uncertainty creates massive opportunity for those that have the cash and the courage to participate when everybody else is scared. Let's dig into that a little deeper. In order for us to do that, we need to understand a little bit of the background. Interest rates prior to March 2022 had reached the lowest we'd seen in the country, in this nation's history, right? The federal funds rate approached zero. And we saw investors purchasing commercial real estate for mortgages in the high 2s and even low 3s. And when interest rates come down, cap rates or capitalization rates also come down, right? They follow interest rates, not in lockstep, but in general they do. And when we see cap rates dropping, we see property values dropping, right? Because the value of commercial real estate is determined as a multiple of cap rate. So when interest rates came way down, cap rates came way down, values went way up, and people started overpaying for things. Why? Because money's cheap. If money's cheap, we can afford to pay more. Now, let's also inject some steroids into this situation, right? Let's put some anabolic steroids and let's juice. In response to the global shutdowns due to the COVID-19 pandemic, many of the world's governments started the largest bout of quantitative easing this world has ever seen. Majority of rich nations started printing money at a level never seen before. And almost every major currency in the world, the supply expanded massively. In America alone, we printed $7 trillion over the course of 18 months. To put that in perspective, that is 40% of all US dollars ever created. And it was made in a small 18-month period, and we printed a ton of cash. And what did that do? What do you think that did to the economy? I remember at that time, I was listening to podcasts, and all these smart economists came along, and they're like, oh, it doesn't matter that they printed all this money. There's so many other deflationary pressures, blah, blah, blah. It's not going to cause any inflation. They got that completely wrong. I was like, hey, I'm a dentist. I don't know anything. If these guys say there's not going to be inflation, there's not going to be inflation. Even though, in my understanding, the mere act of printing money equals inflation. This artificial stimulus, artificial man-made boom by the Federal Reserve created fire in the economy. Everything was going up in value, and everybody was flush with cash through stimulus packages, through infrastructure programs, through expansion of entitlement programs. And for the first time in the nation's history, we had direct ACH payments of stimulus packages from the government directly into individuals' bank accounts. And what we saw was values of everything going up. Metaverse, cryptocurrencies, NFTs, Michael Jordan rookie cards, and anything else that anybody could pass off as an investment. Low interest rates in the free world, plus tons of free money, led to a bout of massive inflation that hasn't been seen in America for 40 years. And so to combat the inflation, that they caused in the first place, right? The Feds caused this inflation in the first place. They said, hey, look, we got to fight inflation now by raising interest rates. And they started the fastest set of rate hikes in this nation's history again. Notice in this video, I've said multiple times, the most in the nation's history. How many times have I said this in this video? And it's not for hyperbole. It's because it's the truth. So anyway, there you have it. That is the predicament of how we got to where we were. A supercharged, super fueled economy where everything, the values were too high. One might even argue that the values were overshot of what their true value was. And a lot of people that say, hey, look, the values have come down over the last 12, 24 years. It's more like it's been a normalization from an overshot from the frenzied investment at the top of the market. Right now we're at the top of the cycle. We're at the bottom of the cycle right now. And this is what creates the opportunity of a lifetime. There are very few lenders out there that are lending. And if they're giving loans, they're low LTVs, as I said earlier. There are fewer investors out there, right? With interest rates are high, economy continues to slow down. More money from business is going towards debt service, providing nothing of value for our society. It's not producing more goods. It's not producing more jobs. It's not producing more research. It's just going into this black hole called debt, right? So our businesses are becoming more inefficient. They're slowing down. As a result, there's less money to invest as well. So it's a negative investor outlook. There are fewer sellers. Sellers are getting offered 30 to 40% less for their properties than they were being offered just 24 months ago. Psychologically, it's hard for somebody to say, hey, you were offering me $22 million for my property just 12 months ago, and now you're telling me you're only going to give me $17 million? You want me to take a $5 million haircut? And a seller that does not need to sell, and they're cash flowing nicely, like, hey, look, I'm not going to sell. I'm going to wait for interest rates to come down so I can get $22 million for my property. And as a result, sellers stop selling. But what happens to the distressed operators that have to sell? This is where the money comes in, right? What happens to those guys that we talked about at the beginning of this video? The guys that have distressed debts in these CLOs. The guys that they know that their interest rates are going to triple or double or triple in just a matter of a mere months. These guys need to sell, and they need to sell now. The alternative for them is to incur huge negative cash flows and or ultimately foreclosure. So to avoid that and try to save as much of their investor equity as possible, they sell, and they're willing to sell at steep discounts from what they bought it for. They're willing to sell at losses in order to prevent more major losses in the near future. This is where we need to back the truck up. We should have plenty of dry powder, meaning capital to deploy, and we need to be ready to move when there's an opportunity in front of us. Because this window is not going to last for a long time. These are short windows where very savvy people really have a lot of activity, and they load up on stuff because they're buying stuff at great discounts. Then they might not transact again. They might not invest again. They might just wait until things calm down, interest rates come down, cap rates come down, values go back up. And they bought it at such low bases just a couple of years ago. Millions of dollars of wealth have been created just by buying right. A lot of people say when you're buying, when the money is made on the entry or when you're buying, this is case in point of how to front charge or front load your chances that this is going to be a great investment. How do you front load it? Because you're buying prime real estate at discounted rates, at discounted values. And if you can buy a whole bunch of stuff at discounted values, desirable real estate, when things do turn around, and they will, this economy, this market, this sector, they all work on a cycle. And if you buy at the bottom of the cycle and sell at the top of the cycle, you will become very wealthy. If you do that over and over again, you will become so wealthy that wealthy won't describe you anymore. I don't know if that makes sense. So the picture being painted is that there's cracks in these CLOs. We know that there's close to $1 trillion of floating rate mortgages for commercial real estate debt that will be maturing over the next 0 to 24 months. And although the specifics are different in this recession versus ones in the past, say for example 2008, we had the great financial recession where we saw a housing market crash, some mass foreclosures, mass short sales. It's quite different this time, right? That same level of it's a different distress in single family homes, but the major underlying principles are the same. You have a chance to buy low and sell high. The more you can buy low and sell high, the wealthier you'll be. And that's why I say be ready to make a lot of moves and invest heavily in real estate. Look for deals that have distress. Look for deals with assumable mortgages at 2.9%. these themselves have value, right? If a guy's locked in a great interest rate, you want to go in at that interest rate instead of at 8%. There is a once-in-a-generation opportunity to invest in scores of primely located multifamily real estate in primary and secondary markets at temporarily undervalued prices. The savviest investors are quietly investing heavily, while everyone else sits on the sideline. And when markets cool, as we said, and inflation cools, and the economy gradually swings back from a bust to a booming cycle, that's when the massive values, that's when the massive profits will be realized. And those that had the cash and the courage to be bold while others were fearful will do very well. So the bottom line is, as the great Warren Buffett says, when others are fearful, be greedy, and when others are greedy, be fearful. I believe that pertains very well as the punchline to this entire video. So the only question that remains is that, are you going to sit and watch this opportunity come and go? Or are you going to be one of the people that take advantage of it and do your future self and family a huge favor? Now, how do you take advantage of this incredible opportunity? If you haven't joined our investor club, definitely join Walk of Wealth Capital. We are on the hunt for these type of investments. We've already found 2 great investments that we've helped our investors to now participate in prime markets, Phoenix, Dallas. And we are on the hunt and lookout for more of these type of properties. If you want to gain access to these investment opportunities, please do join our investor club so that you don't miss out. You can find the link in the description below. Of course, if you're interested in learning more about investing alongside us in quality commercial real estate across the country, and if you just have questions or you need help building a strategy, I encourage you to schedule a call with myself or one of my helpful teammates. You can schedule a call. The link should also be in the description below, and I look forward to speaking to you. All right, guys, continue on your wealth building, keep your pockets growing and the information flowing. Click on the next video, and I'll see you there. See you next time, guys.